Hi, and welcome to the Profit Playbook. Perhaps you're a manager and you've been approached to actually buy into the business that you work for. One of those options has been through a management buyout. This is the video for you. So between myself and my colleague, Ed Gooderham, we're going to be navigating these issues and exploring some of the more detail of what to look out for in this transaction. So let's get into it. Thanks for coming back to the show, Ed. So this is a follow-on from what we were speaking about previously on another video, which is talking about management buyouts, but from the buyer's perspective rather than the seller's perspective instead. Yeah. And if anybody wants to know a little bit more about what a management buyout is, we've got a link to the video of exit strategies in the comments below. So let's kick off by just trying to understand a bit more from the buyer's perspective in this management buyout. So why would someone consider doing a management buyout instead of, say, maybe starting out on their own or just buying a separate business that's potentially unrelated?
Very good question. I mean, in essence, most people who are managers in a business who might be involved in a management buyout or looking to be part of a management buyout, they have never owned a business. They've never probably wanted to set their own business up. They've always been fairly happy at the level they're at. They're probably very senior in their organization, so they've got a lot of autonomy. And they can make a lot of decisions. And they probably like that. This is the next stage, really, of the person who owns a business is getting to retirement. And they want to retire, and therefore they're giving options of you guys stepping up and being the new owners. And that's normally how these things come about, from my experience. And I've had several of these situations come where clients phone me up and said, look, we're looking at doing a management buyout. Can you come and talk to us about it? Talk about how we can structure it. What's involved, and also they've never been business owners. Yeah. What does it mean to be a director of a company?
It's actually a good question. So if someone was considering doing a management buyout, I'm assuming there's going to be a lot of things to consider. So what are some of the things you would highlight that are worth considering in that scenario?
Yeah, so like I was saying, the first thing is about buying the person out. The first question I normally get is, how do we do it? Because they've never done it before.
Hold my hand.
They say, well, do we have to take the income out first and then pay the tax on it and then buy the shares off him personally?
Yeah.
That's a annoying way. I stop it and say, no, you don't do that because that costs you far too much.
I have seen that in the past. It's terrible.
Yeah. So what we always do with clients is we look at ways of doing it with the minimum amount of tax. And one of the normal ones is you create a holding company, which the new management team own, and they buy the shares off the exiting business owner.
Okay.
Because then all you're paying is the profits in the company for corporation tax, and that just gets divvied up to the holding company to pay the individual out. So that's normally the most tax efficient way of structuring it, which is normally the first question.
Okay.
The second one is, how are we going to fund it?
Yeah.
Because we haven't got any money. We've just been employed in the business. We've never run a business before.
Yeah.
So again, normally the business owner might have been planning for his retirement. So there could be a lot of cash built up in the business that he wants to take out as one of the big lump that he wants.
Yeah.
He's also normally fairly willing to let it be over a period of time in deferred payments for most of the consideration for the payment of buying the business. And if that's a scenario, the profits of the business are used to pay him for the business every month or every year. And that's the most straightforward way that most of these things happen.
Okay. So a lot of the consideration there then is making sure that potentially, if this is the way they're going to do it, is that there's sufficient profits in the business overall to make sure that this can actually be done. Do you tend to advise the buyer's position to do the due diligence and look into the business, the models, etc.?
The best bit about it is they've been in the business for years. So normally they know the business inside and out. So that saves an awful lot of due diligence. They know what's gone on. They know any skeletons are in the cupboard. Hopefully. So all those things get discussed fairly quickly and sorted out. And you can put warranties in place. If the guy's done tax schemes or something's happened in the past, you want to highlight and to say, if anything goes wrong with this, can you cover it because it was your fault? And that's fairly straightforward and fairly normal. And that's all dealt with in the share purchase agreement. The main thing for the clients, like you were saying, is the profitability of the business. Again, they've been involved for a number of years in the business, so they know if it's doing well or not. They might not have seen all the figures, though. And this is where the business owner might have to start sharing financial information with them, which is when they then come to an accountant because, again, they've never read a set of accounts. so they don't fully understand what they mean possibly. And so I get lots of clients who bring me a set of accounts, and then we talk through it and explain how the business is doing. Is it worth the money the person who wants to sell wants for it? And if not, then we look at alternative ways of financing it in terms of a longer period of time. We try to steer away from getting loans for our clients when we do management buyouts, because you've then got the fluctuations in interest rates or different things that could cause an issue. It's also a big fixed cost for them.
Okay, so you mentioned about using an accountant to help with a lot of this element, and so you've had some clients come to you about approaching you for a transaction like this and some advice around it.
Yeah.
Would you recommend, from the buyer's perspective, actually going to a separate accountant outside of the existing accountant of the business?
Good question. I've had both. So,
Okay.
and the main thing there is you're looking for independence.
Mm.
So you're looking for somebody who's who got your interests at heart. And if you're going to the same person that the seller's dealing with, there's a natural conflict, isn't there?
Yeah.
Because the seller wants as much money as possible. Potentially, you want to pay the right price, not underpriced, but the right price for it.
Yeah.
It all depends how agreeable the whole situation is, and how much the existing owner is just looking for the ethos to carry on with the new buyers, and he really wants to pass it on to them.
Mm.
But I do think it's a very good idea to get independent advice.
Yeah.
And it could be the case that you do want to go to someone else, just to make sure you have got that good independent advice, and all they're interested in is your interests and not the other parties.
Yeah. So maybe even just as a project, doesn't have to be a long-term thing, potentially.
The problem is you
do develop relationships.
You do
with
develop
your accountant,
relationships.
I know.
You're also asking for the most important advice when you're starting a business.
Yeah, and it's such an intimate point of your life, isn't it, in the process? If you're getting the advice from an external accountant outside of the existing business, then it's very likely that you're getting that relationship, isn't it?
Probably other than buying a house, it's going to be the most expensive transaction you ever do.
Yeah.
So you really want the person who's giving you the advice to then help you along the way to make sure it works and is a success.
Yeah, true. So quite a lot of things to manage there. So in terms of another big thing to manage, and you mentioned about it's the biggest decision that most people would make. So naturally, price sensitivity is a big concern for buyers, at least, as well. It's because they haven't had the affordability of developing a business over the many years. So how would, from the buyer's perspective now, how would a client look to agree a price with the seller?
That's a very good point. The seller has a price. They probably talk to their accountant and they give them a valuation of the business. There's no one value for a business. I'll say to a client, look, I can give you a range of values, and then somewhere between those ranges is where you come to a compromise with the other party. And that's the important thing to always remember in this situation. You're also normally in a management buyout, got a situation where the buyer is giving a little bit of value away. So you normally are getting a good value when you buy businesses this way, because the person wants the management team to succeed and do well, and therefore they want to encourage them to get to that point. But you should get it valued and make sure you're happy the value is right. You need to look at the profitability of the business. Words like EBITDA, earnings before interest, tax, depreciation, amortization come into mind.
Well done for remembering that. It's always a tricky one.
Looking at net asset values of the company, perhaps the existing owner wants to take the property out of it, and then that complicates things a little bit when you're looking at balance sheets. But it's easy for an accountant to explain these things to you. Yeah,
but it's obviously a natural minefield for a client in general, even if they are experienced. When you're new to it, it's going to be extremely brand new, isn't it?
Well, this is the problem. And so it could be the first time you've ever seen a set of accounts. Yeah. Suddenly someone's saying they're going to strip out the property out of it. Well, what does that mean? So you have to bear these things in mind.
Yeah. Again, quite a lot of information there, especially for someone who's newly introduced to self-employment potentially. And this is obviously going to be one of their biggest transactions. So if we were to try and summarize this as best as we can, what are some of the key takeaways that a buyer would be looking at?
Advice. You need someone to help you with this. It's not straightforward buying a business. So you need a good accountant who can help you through that and give you the advice about, is the valuation right? Can the business afford to make all the deferred payments?
Very good point.
Is it going to put too much stress on the business, and therefore you need to negotiate a lower price or a longer payback period?
Interesting conversation.
Yeah.
Because you're still employed at that point.
It's still your boss.
As well. Yeah.
You're telling your boss, actually, boss, you've overpriced this. And the big issue really is just trying to get to a fair figure that works for everybody.
Yeah.
The buyer at the end of the day and the seller have the same plan. They want the business to succeed and continue. The nice thing for the buyers is hopefully their income is going to go up after they've paid the existing owner off.
Yeah.
So they've got that future benefit to look forward to. But hopefully they can also grow the business in the meantime. They've probably got ideas of their own of how things could be improved. Perhaps the existing seller didn't always want to change things as much as other people would like to. But they've also got a lot to learn because they might not have done everything in the business before. Perhaps the existing owner did a lot of the HR, a lot of the compliance, or a lot of the accounts, or other parts of the business. And there's those steps that someone will need to learn. And again, having an accountant alongside you. For myself, when I got management buyouts, we often meet either monthly or quarterly to try to help along those steps because there's lots of new things.
Yeah.
And there's no silly questions in my view. Because, okay, I've seen it several times before. They never have. And this is so important to them.
Yeah. So absolutely take advice. That's key. And making sure you can, I think it's finding the mutuality and respect between yourself and the seller, isn't it? In this example, that hopefully will give you the formula for a really successful transaction, ideally.
Exactly.
That's brilliant. Well, thanks very much for coming on the show, Ed. And hopefully I'll see you again soon.
Thanks very much.
Thanks everyone for listening. If you want to know a little bit more about the topic from today's episode, please don't hesitate to download the free ebook below in the links in the below. And if there's any other topics you'd like us to discuss, please don't hesitate to put them in the comments below. Thanks again for tuning in, and don't forget to like, share and subscribe.